What is good, Stackers University? Thank you for coming back to part two of It's Coming. If you didn't see part one, I'll give you a quick 30-second summary. In a nutshell, globalization has resulted in ever cheaper goods, which had a deflationary effect on the world. Specifically here in the US, this coupled with a Fed policy that lowered interest rate every time we ran into financial troubles until it ended up with a ZIRP policy, zero interest rate policy, which resulted in 40 years of a very benign economic environment. This had a tremendous impact on bonds, but especially financial assets like stocks and real estate. This era of incredibly cheaper dollar resulted in a number of bubbles and overvaluation of financial assets, as we learned that the Fed can control liquidity, but it cannot control where the dollars flow. We can see the impact on this if we look at this chart of the ratio between real assets and financial assets. This has created an imbalance and an opportunity for those who are willing to do the work and show the courage in their conviction. We really start to see this imbalance when we look at charts like this that compare the performance of commodities to the S&P. This brings us to present day, where the market conditions are shifting from a low inflation and low interest rate environment to the exact opposite, especially as we may be repeating what happened in the 1970s when we experienced three distinct waves of inflation. Coupled with slowing or low GDP means we could face stagflation. We could already see the impact of these shifts as we just saw the 6-month T-bill exceed the S&P in terms of yield. When we look at traditional economic cycles, and it seems that we are somewhere around overheated and stagflation. All of this is extremely important because as the market conditions change, it has profound impact on how money rotates between sectors. The question many investors are grappling with is, why would I keep my money in stocks when a 6-month treasury bill provides me a better return with almost zero risk? As the Fed talks about higher and longer and people debate who is going to buy all these government bonds, well, if interest rates get high enough and stay there long enough, we are surely going to see investors say, why not take these bonds at 6%? As opposed to stay in the stock market with the risk. Higher interest rates are very bad for the stock market and should cause money to rotate out of the stock market, and that money will need to find a home, likely in bonds, while others will slowly realize that the 40-year S&P party, where all you had to do was keep buying the dip, is coming to an end. They will finally realize that they have to get out and move their money somewhere else. Again, this is so clear when we look at the ratio of real and financial assets. Now let's talk about how you can potentially make life-changing gains by positioning yourself before the herd or the masses come rushing in, as this is absolutely the best way to multiply your money. As Warren Buffett says, you buy straw hats in the winter. Why? Because nobody else wants them and they're dirt cheap. This is a challenge because most investors wait for price confirmation and for the price to go up before they start buying an asset. When you do this, you miss two very influential opportunities. One is buying at lower prices with less competition, and two, the time benefit of accumulating more of the asset over time. This is exactly what we've been doing for the last 2 years, buying gold as low as $1,600 and silver around $17. I need to warn you though, that being early to a sector will often feel like you are wrong. You're not. This is where you have to practice, wait, and accumulate. It's like going to a club at 8 p.m., the dance floor is empty, and it's only you, a few other people, and the employees. However, come 11 p.m., it will be packed with people, there won't be any seats, and getting a drink will take you 30 minutes. But because you got in there early and enjoyed yourself, it becomes that much easier for you to leave before the party is over and everyone is rushing to get out at the same time. This is the exact analogy I want you to keep in mind when it comes to investing. The key is getting in early, avoid getting in with the masses, and leaving the party before it's over, or selling the investment early before the masses are all trying to get out at the same time. If we understand that we need to get into these investments early, the next logical question is, how do we find those investments? Because it's not as simple as buying a bunch of penny stocks. This is where the economic cycle and ratios will serve you well. In one snapshot, ratios can show you how expensive one asset is in relation to another asset against its historical average. In our case, we now know, thanks to the ratio of real assets and financial assets, as well as the economic cycle, that real assets, especially commodities, are where we need to be looking. Get your finger ready to hit pause and take screenshots, because I'm going to go through these relatively quickly. Let's review, how do you develop your investment thesis? And these are the basic questions you have to ask yourself. 1, where are we in the economic cycle? 2, what sector is historically undervalued based on ratios? 3, what are the current economic conditions? 4, under what conditions would that sector increase in value? And 5, is it likely that those conditions are coming? And 6, do you have the patience to accumulate and wait? Again, our thesis is that real assets are at a 100-year low compared to financial assets, coupled with a new paradigm of higher interest rates and higher inflation. Let's start with a look at the anatomy of a bubble chart. I've shown you this chart since 2001 when I started this channel. Some of you may see a different version from Chris Vermillion that he uses. Either way, look at the shape of the charts. Now look at the shape of the S&P 500 starting right after the dot-com bubble in 2001. You can't tell me those charts don't look identical, period, in the sentence. I point this out to you so that you have another data point of confirmation. I showed this in the last video, but here is the ratio of commodities compared to the S&P. Now, gold miners to oil companies. Look at that. Next, we have the history of the 60-40 portfolio, which shows that we are headed downwards from the highs. So we can expect that to serve as a tailwind of sort as people flee the traditional advice of a 60-40 stock bond portfolio. But where will that money flow? Hold tight. Based on this chart, which is the ratio of the NASDAQ versus Treasury, they aren't going to the NASDAQ. Here's a hint. This chart shows the gold to Treasury ratio, which is clearly trending upwards in favor of money flowing to gold since 2000. How can we confirm that? Look at gold's performance in all the other major currencies. Yep, those are all all-time highs, except for in the dollar. This also speaks to why we are seeing such an arbitrage in spot prices between the East compared to the West. What else may be driving that? Well, this chart shows that how outside the United States, people aren't buying treasuries. Instead, they're buying gold, just like we're seeing with central banks. This chart shows the 3 bull moves of a gold market. Looks a lot like the Elliott wave theory I've shown you here before, where you have one move up, a move down, up move 3, down move 4, and up move 5, which we are just starting. Here's another chart showing the same concept. Somehow, all of this has happened since 2000, and no one seems to notice that gold has outperformed the S&P 500 as this chart shows. Want more proof? I got you. Here's gold versus the NASDAQ. Looks like a breakout from a falling wedge, which we all know is very bullish. Before my silver folks get mad at me, here's a silver versus the NASDAQ 100 and a chart of silver to treasuries ratio, which looks like silver has broken the downtrend and is now sitting on support. We often don't talk about Dr. Copper, but look at this copper versus the NASDAQ. Looks like a double bottom that is poised to increase from here. Those are all great opportunities in my opinion. We're a stacking channel, so let's really zoom in on gold. And when I say gold, let's pretend that I'm saying gold and silver at the same time. I make no apologies about my belief in mining stocks because of their leverage to the gold price. But what if I told you that since 2000, physical gold gave you a better return than the Huey Mining Stock Index? Yep, that's actually true. This chart shows you that since 2000, physical gold has performed better, but not so fast, my friends. I want you to also notice the movements, not just the starting and the end points. I'd like to also add that this is an index, which means in an index, you get the big winners and you also get the big losers along with it. This is why I very rarely talk about buying indexes like the Huey, the XAU, GDX, and I definitely don't talk about buying SILJ. Regardless, this trend holds true if you start in 1971 and compare gold to Barron's Gold Mining Index. At the same time, if you dig a little deeper, you can see that on a ratio basis, the Barron's Gold Mining Index is actually historically low compared to the price of gold. This really speaks to how poorly mining stocks have performed over the last 10 years in particular. A reversion to mean would cause this ratio to go from 12 to somewhere around 50 or 4 times higher. Regardless, it's clear that gold and silver are poised to give phenomenal returns, and physical metals are absolutely one of the best ways to play this market if you don't want to deal with the hassle of picking stocks. I also want to remind you and open your minds to the idea of other sectors that present tremendous opportunities as well, especially in light of the financial assets being overvalued. Take a look at these charts. How about natural gas? Look how low this ratio is. Or oil and gas explorers and producers. How about uranium as a decent value play? Or even copper. You might not believe this, but regional banks are a very low ratio, and even home builders. And last but not least, look at this ratio of agriculture represented by MOVE divided by the S&P 500 again. All of these things are showing you that they are at historical lows, which reinforces this idea that there is going to be a shift from financial assets over to real assets. So no matter how you slice it, that is just clear. The question then is, how do we capitalize on it? And I have to tell you, I can't wait for money to hit my bank account because I can't deploy it fast enough between metals, metal miners, uranium, energy, coal, and oil stocks. Obviously, I can't tell you what to do, but I hope that I've shown you enough data to convince you to take some action. And if you do take action, remember, being early is going to make you feel like you're wrong. But as long as the conditions remain and your thesis is intact, you simply accumulate and wait. because big moves are coming to real assets, starting with physical gold and silver. In the comments, what is your percentage of physical gold and silver to mining stocks? What other commodity sectors do you invest in or are you considering investing in? Or simply put an A+ in the comment section so that everyone knows that you always stack smarter and never stop learning.